I want to start with something that completely changes how you should be viewing the gold market right now, because what you're about to hear is not what most people are talking about. As of March 28, 2026, gold is sitting at $4,428 per ounce, down 21% from its all-time high of $5,596, which it hit just weeks ago on January 29th. That kind of drop gets attention. It raises eyebrows. And naturally, it raises one big question: what's really going on? Over the past 48 hours, I've gone deep, analyzing vault movements, central bank activity, IMF data, and reports from the London bullion market. And what I discovered flips the mainstream narrative on its head, because here's what most people are being told. Gold is falling because the dollar is strong and bond yields are rising. Yes, that's part of the story, but it's not the whole story. That there's another force at play. One that Wall Street saw coming, but almost nobody took the time to explain to everyday investors. And until you understand the second force, you won't fully grasp what's unfolding right now, or why the next phase, what I call the biggest reset yet, could dwarf everything we've seen in this bull run so far. Now, let me show you something that should make you pause. Turkey's central bank sold and swapped 60 tons of gold, over $8 billion worth, in just 2 weeks. Let that sink in. This wasn't a routine portfolio adjustment. This wasn't a strategic rebalance. This was something else entirely. This was a central bank getting margin called by a war. Sounds dramatic? It is. And I'm going to break it down step by step, because this is the part no one is explaining clearly. But before we go deeper, ask yourself this. What happens when an entire country is forced to sell its gold just to stay afloat? Here's how it unfolds. Turkey imports around 90% of its oil and nearly 98% of its natural gas. That means its entire energy system depends on global prices, and more importantly, on the US dollar. Then, on February 28th, the Iran war begins, and almost instantly, Brent crude surges from $75 to over $100 per barrel. No slow climb. No gradual adjustment. An immediate shock. That single move added roughly $20 billion to Turkey's annual energy bill overnight. Now, here's the critical detail. Those energy contracts are priced in dollars, not lira. Suddenly, Turkey needs far more dollars at the exact moment its currency is collapsing. Since February 28th, the Turkish lira has hit new record lows against the dollar at least 11 times in just 16 trading days. Think about that pace. That's not volatility. That's free fall. And when a currency spirals like that, the consequences stack up fast. Inflation accelerates, confidence erodes, and political pressure builds. Turkey's inflation is already sitting at 37%. If the lira keeps dropping, that number doesn't just rise, it explodes. The central bank is cornered. And it has only 3 choices, none of them good. Option 1, let the lira collapse completely. That's political suicide. Off the table. Option 2, burn through dollar reserves to defend the currency. They're already doing that, and reserves are running thin. Option 3, sell gold, convert gold into dollars, use those dollars to stabilize the currency. And that's exactly what they chose. JP Morgan estimated that up to $30 billion worth of Turkey's assets, out of $135 billion held at the Bank of England, could be used for this kind of emergency move. They acted. 0.60 tons. 2 weeks. $8 billion. That's not strategy. That's survival. That's a forced liquidation. The kind you'd expect when a trader gets a margin call. Except this time, it's not a trader. It's an entire nation. And here's where it gets even more important. Turkey isn't alone. And if you don't understand what comes next, you could completely miss what this means for gold, for markets, and for what's about to happen next. Now, let's bring this closer to home, because what happens next doesn't just affect countries. It affects your own gold position. Take a look around the world right now. Russia has already begun selling gold in 2025 to help finance its war efforts, generating $2.4 billion by February 2026 and pushing its reserves down to a 4-year low. Meanwhile, Poland, one of the most aggressive gold buyers over the past 3 years, is now considering allocating 550 tons of gold, worth roughly $13 billion, toward defense spending. Different situations, same direction. Now zoom out even further. China paused its gold purchases in Q4 of 2025. India turned into a net seller in January 2026 due to pressure on its currency. Ask yourself this. What do all these signals have in common? Turkey is selling. Russia is selling. Poland is preparing to sell. China has stopped buying. India is selling. These weren't just participants in the gold rally, they were the drivers. And now, almost simultaneously, they are shifting from aggressive buyers to sellers, or at the very least, sellers in waiting. So here's the question that should stop you in your tracks. If the same central banks that push gold from $1,800 all the way to $5,596 are now stepping back or stepping out, what happens next? Most people think they know the answer, but they're wrong, because when you really dig into the data, the truth points in the opposite direction. And this is the single most important insight you need to understand right now. So let's break it down. What is a reset in the gold market? Because this isn't new. In the last 40 years of capital markets, we've seen this exact pattern play out multiple times. In 1976, 1983, 2008, and 2013. And every time, the story was the same. It wasn't strategic selling that caused the drop. It was forced selling. Central banks that had spent years accumulating gold suddenly found themselves in crisis, cut off from dollar inflows, under pressure from currency instability, or hit by external shocks. And in those moments, they didn't sell gold because they wanted to, they sold because they had no choice. And when that happens, prices fall fast. Now here's where psychology takes over. Retail investors see the drop and assume the bull market is over. They panic, they sell. That adds even more pressure, pushing prices even lower. But then something shifts, and this is the part most people miss. At some point, the forced selling runs out. The crisis that triggered it begins to stabilize. Dollar demand, which spiked due to shocks like rising oil prices, starts to normalize. And when that happens, the real buyers come back, because central banks don't abandon gold as a reserve asset. They never have. They didn't sell because they lost faith in gold. They sold because they were cornered. And the moment they're no longer cornered, they return. So what we're seeing right now isn't a permanent shift in policy, that it's a temporary reaction to extreme conditions. Think about it. If energy markets stabilize, if key supply routes normalize, and oil prices pull back into that $85 to $90 range, pressure on currencies like the lira begins to ease. Emergency interventions slow down, and the wave of forced selling starts to fade. At that point, the supply picture stabilizes, but the demand story, that never left. The long-term forces are still there, quietly building in background. Central banks are still looking to diversify away from dollar-based assets. Geopolitical tensions are still fragmenting the global system, and fiscal deficits across developed economies continue to expand. All of these factors create one powerful, consistent incentive: hold gold. Which brings us back to the big picture. This isn't the end of the bull market. This is the reset, the clearing phase. The moment where excess gets flushed out, weak hands exit, and forced selling distorts the price. Right before the next move begins, liquidation that ultimately sets the stage for the next, much larger move. But here's where things get even more important, because I want to be crystal clear about why what's coming next could be the biggest reset we've ever seen in the gold market. Let's rewind for a second. When gold began its historic bull run back in 1973, the national debt of the United States was just $500 billion. Today, it's over $39 trillion. That's not just growth, that's a completely different financial universe. A system operating under entirely new pressures, and those pressures create a much stronger long-term case for gold than ever before. Now think about this. Back in 1973, not a single central bank was strategically accumulating gold. There were no coordinated reserve strategies, no structured accumulation pipelines, no sophisticated infrastructure like swap lines or custodial systems through institutions such as the Bank of England. That entire system simply didn't exist. Today it does, and it's massive. Central banks are projected to buy around 850 tons of gold in 2026, nearly matching last year's pace, and still far above the 400 to 500 ton average we saw before 2022. Even now, amid all this selling pressure, the long-term demand engine is still running. But that's not all. Back in 1973, there was no structural supply deficit in silver, no explosion in demand from emerging technologies, no global race for resources driven by AI infrastructure, and perhaps most importantly, there was no large-scale shift away from the dollar. But today, that shift is happening in real time, and there's one moment that accelerated it more than anything else: the freezing of Russia's foreign reserves in 2022. That single action changed how countries think about money, because it revealed a hard truth. If your reserves can be frozen with a keystroke, are they really reserves? Gold answers that question differently. Gold has no counterparty risk. It can't be printed. It can't be devalued overnight, and can't be sanctioned. That reality didn't change just because Turkey had to sell 60 tons to defend its currency. Turkey didn't sell gold because it stopped believing in IT. IT sold gold because it needed dollars immediately in the middle of a crisis. And when that crisis passes, Turkey will be back, buying again, for the exact same reasons it was buying before. And it's not just Turkey. The same logic applies to Russia. The same applies to Poland. The same applies to every central bank currently under pressure from dollar demand triggered by the Iran war. Oh, let's be absolutely clear. This is not the end of a gold bull market. This is the most intense and most dramatic reset within it. And here's the part most people overlook. Resets are where the biggest opportunities are created. Now, let's move from theory to action. Because I want to give you something tangible, a clear framework you can actually use. Let's talk about the three-phase playbook from here. Phase 1, the phase we are in right now, is the forced liquidation phase. As of March 27, 2026, gold is trading around $4,428 per ounce, down 21% from its peak of $5,596 on January 29. That drop is real, the selling is real, but the motivation behind it, that's what matters most. These aren't strategic exits. These are obligations being met under pressure. Turkey is defending its currency. Russia is funding a war. Poland is preparing for potential defense spending. This is not optional selling. This is necessary selling. And because of that, it has a limit. Countries cannot sell more gold than they physically hold, which means the selling, no matter how aggressive it looks, is finite. And that leads us to the most important question right now. Where is the bottom? How much more selling is left before the pressure exhausts itself? Because once that answer becomes clear, everything changes. And based on the latest data, including reports showing Turkey's central bank drawing down nearly 58.4 tons of gold, we're starting to get closer to that answer than most people realize. Let's keep going, because the details here matter more than most people realize. Turkey's central bank reported a massive drawdown across just 2 weeks, 6 tons in the week of March 13th, followed by a staggering 52.4 tons in the week of March 20th. Pause for a second and think about that pace. That's not gradual selling, that's urgency. And according to JP Morgan, Turkey has roughly $30 billion in precious metals that could be used for further operations. But here's the key insight. That number has a ceiling. Turkey does not have unlimited gold to sell, which means this wave of liquidation, no matter how intense, is inherently finite. Now let's widen the lens. Saudi Arabia holds about 323 tons of official gold reserves and, based on the latest IMF data, has shown no confirmed selling. United Arab Emirates sits at roughly 11 tons, while Kuwait holds around 79 tons. There's been speculation about selling from Gulf states, but here's the truth. Outside of Turkey and Russia, the data doesn't confirm it.so. While rumors circulate, the actual, measurable pressure is far more concentrated than most people think. Now here's where the story shifts. Because after forced liquidation comes something very different. Phase 2, stabilization. And this phase begins with one critical trigger. Energy prices. When oil starts to stabilize, everything else begins to follow. As supply routes adjust and producers like Saudi Arabia increase output or reroute flows, the strain caused by disruptions, particularly around the Strait of Hormuz, begins to ease. And when that happens, energy importing nations don't need as many dollars as urgently as before. That pressure starts to fade. At the same time, geopolitical signals begin to matter. Donald Trump has hinted at potential negotiations with Iran. Discussions, he claimed, were already in progress as of March 26th, even though Tehran has denied them. Now ask yourself this. What happens if those tensions cool? Even slightly, oil prices stabilize, somewhere in the $85 to $95 range. Dollar demand softens, and suddenly, the pressure on currencies like the Turkish lira begins to ease. When the lira stabilizes, the emergency selling slows down. And when that selling slows, the gold market stops reacting to crisis conditions and starts rediscovering its true structural value. That's phase 2. But it doesn't end there, because what comes next is where the real opportunity begins to take shape. Phase 3, structural reentry. This is when central banks, the same ones forced to sell during the crisis, begin to step back in as buyers, not immediately, but historically. These resets take about 12 to 18 months to fully play out, and when they do, the buyers return. Look at China and India. Neither has signaled any long-term abandonment of gold accumulation. In fact, China extended its buying streak for 15 consecutive months through January. The strategy hasn't changed, only the timing has. These are still structural buyers that they've either paused, slowed, or temporarily sold under pressure, but they haven't walked away. And when they return, and they will, They'll be entering a market that is already reset, a market where prices have been pushed down by forced selling, a market where the opportunity is larger than it was at the peak. Now, add one more layer to this. Russia is introducing a major shift starting April 2026, banning the export of gold bars above 100 grams. Think about what that means. Every holder of gold in Russia who wants liquidity in international markets has a limited window to sell before that door closes. So what do? They sell before the deadline, which adds even more temporary pressure to the market. But here's the twist. Once that window closes, once the pre-deadline selling is done, that source of supply disappears completely. Not only does the selling stop, but a portion of global gold supply is effectively locked out of international markets. So let that sink. In short term, more selling pressure. Long term, less available supply. And that combination, that's powerful. Now let's bring this all together, because as we move forward, there are two signals I'm watching more closely than anything else to identify when Phase 2 truly begins. The first, the Turkish lira. Since February 28th, it has hit record lows at least 11 times. That's your stress indicator. When that stops, when the lira stabilizes, it tells you the forced selling cycle is beginning to break. And when that happens, you're no longer in the panic phase, you're stepping into the transition. And that's when the real shift begins. Now here's where everything comes together, and where you need to pay very close attention. As the pressure on Turkey's central bank begins to ease, the urgency to sell gold in order to defend the currency starts to fade. And when that happens, one of the two largest confirmed sources of selling pressure in this entire market begins to turn. So here's what you watch. Watch the USD/TRY exchange rate. The moment it stops printing new record highs, something important is changing beneath the surface. And when that shift happens, watch gold, because that's your first signal that the forced liquidation cycle is starting to break. But that's only half the story. The second signal is even bigger, and it sits at the heart of this entire crisis, the Strait of Hormuz. Every single week that this critical passage faces disruption is another week of elevated dollar demand from energy importing nations. Every week oil remains above $100 per barrel is another week that forces countries like Turkey to keep selling. Another week that drains dollar reserves across the Gulf. Another week that pushes central banks closer to liquidation. So ask yourself this. What happens when that pressure finally eases? Watch Brent crude. Watch tanker flows through the strait. Because when oil begins to fall back into that $85 to $90 range, the core reason behind this cascade of forced selling starts to disappear. And when both of these signals stabilize, the lira and oil, that's when the real shift begins. Now let me tell you what I believe happens next. JP Morgan has already raised its gold price target to $6,300 per ounce by the end of 2026, with an upside scenario reaching as high as $8,000. And here's the part most people miss. Those projections were made before Turkey's $8 billion sell-off, and they haven't been pulled back. Think about what that implies. Institutional research teams, the ones building these forecasts, are not looking at gold falling from $5,596 to $4,428 and concluding that the long-term story is broken. They're seeing something very different. They're seeing forced liquidation, creating opportunity. Because that's what always happens before a major reset. And I've seen enough of these cycles to say this with confidence. Forced selling does not change the destination. It changes the price you get to enter. Let that sink in. The biggest reset wasn't the drop we saw in January. It's happening right now. Late March 2026, as Turkey offloads its final reserves, as Russia approaches its export deadline, as Poland debates monetizing its gold, and as China quietly waits, its long-term accumulation strategy still intact. This is the reset. And resets do one thing above all else. They establish the floor. Now, based on all the data, all the flows, all the pressure points, all the structural signals, that floor appears to be forming somewhere in the $4,000 to $4,500 range. And if that's true, then what you're looking at right now isn't the end, it's the launch pad. So here's how you move forward. Pay attention to the lira. Pay attention to Brent crude. Stay patient. Because now you understand something most people don't, and if you let a phase of forced liquidation shake you out now, you risk missing the biggest move still ahead in this gold bull market.